Hi everyone. Thanks so much for joining tonight's webinar. My name is Gerald and I will be sharing more about the Astrea PE bonds with you today. Okay, so I believe some of you might have read the news about this Astrea PE bonds being asked. We see quite a number of questions in the Beansprout community about the Astrea bonds as well. So we thought it might be helpful to just organize this session, share with everyone more about the bonds, how we can look at the pros as well as the cons of the bonds, and then lastly, sharing how to apply for the bonds. Okay, so I know many of you have questions about the bonds, so we'll leave time at the end of today's session for you to be asking these questions. Okay. So before we start, just a few things to highlight. In case you have not heard of Beansprout, so effectively we provide financial insights to help you make better financial decisions. You can find us on our Telegram, on our social media channels, such that if you have more questions after today's session, you can find us through these social media channels as well. Okay, so a few things that we'll cover today, including an overview of the bonds, what we like about the Astrea PE bonds, some of the key risks that we need to be aware of. Lastly, we'll share our thoughts about whether we think it is worth applying for the bonds, as well as how to apply. Okay, but before we start, just for today's purpose, I would like to highlight that whatever is shared today is actually for information purposes only. It should not be taken to be financial advice. So as to whether you would want to be applying for the Astrea PE bonds, do think about your individual investment objectives, risk appetite, and speak to your financial advisor before making a decision. Okay, so quite a lot of things that we can go through today. What we'll start with is actually around starting with the overview around the PE bonds. And I wanted to just give a quick overview here in terms of what are we looking at, okay? So first and foremost, we can actually look at the Class A1 as well as Class A2 bonds. So what we need to be aware of is that there are two separate tranches of the bonds, okay? The first one, which is Class A1, they offer a fixed interest rate of 4.35% per annum. Okay, the public offer for the Class A1 shares is larger at 260 million, okay? So this is part of a larger offering of the Class A1 bonds. So previously, there's already been some offer for the Class A1 bonds, and that will actually be another 260 million of the Class A1 bonds. Okay. Next, we have got the Class A2 bonds, which are denominated in US dollars, and they actually offer an interest rate of 6.35% per annum. Okay. So as we can see here, the issuance of the Class A2 bonds is actually smaller, and we are looking at a public offer of just 50 million US dollars of the Class A2 bonds. Okay, so that is a quick overview around the bonds. Next, we can have a quick look at actually what are the Class A1 and A2 bonds and what are some of the features relating to them. Okay, so earlier I've already shared the interest rate relating to both of them. So 4.35% for Class A1 and 6.35% for Class A2, which is US dollar denominated. Okay. So we can see from this table here some of the key features. In terms of the expected rating, both of them are expected to be investment grade bonds. So A+ rating for Class A1 and A for Class A2. Okay. The other key point that I would actually highlight would be relating to the scheduled call date. Okay. So while the bonds actually mature at a later date, we can actually see that both of them have actually a scheduled call date. For Class A1, it will be on the 19th of July 2029. So effectively, we are looking at this being 5 years from now. And then the Class A2 shares will effectively be on 19th July 2030. So that would be 6 years from the expected issuance date. Okay. So the scheduled call date is something that is important, and that is why I wanted to highlight this. Okay. So what we need to take note from here is that there is a one-time interest step up if the bonds are actually not redeemed at the call date. Okay. So effectively, what we see here is that if they are not redeemed on, say, 19 July 2029 for the Class A1 bonds, then effectively the interest rate will be stepped up from 4.35% per annum to 5.35% per annum. Okay, so that to me is something that we need to take note of because of the fact that there is a mandatory call that is happening 5 years from the issuance date of the Class A1 bonds and 6 years from the issuance date of the Class A2 bonds. Okay, and effectively, as a bondholder, you can get this interest rate step up if the bonds are not actually redeemed on the call date. Okay, so that is an important feature to take note of. Next, I think given that this is a bond issuance, what we would start to look at would be how good or solid the issuer track record actually is. Okay, so what we need to know here is who is actually the issuer of the bonds, and what is actually the background of the issuer. Okay, so for Astra, effectively, what we need to know is that the parent of the issuer as well as the manager is 𝗲𝘂𝗃𝗀𝗃. Okay, so you probably come across this name. 𝗲𝘂𝗃𝗀𝗃 is actually one of the entities of Temasek. But what we need to be very clear is that this would not mean that the bonds are actually guaranteed by Temasek Holdings. Okay, so that is something that I will constantly highlight as we go through today's presentation. But I think first and foremost, we need to see who the issuer of the bond is. Okay, so 𝗲𝘂𝗃𝗀𝗃𝗀 was actually established back in 2015. What their key objective is actually to broaden investor access towards private equity. And as of December 2023, they have assets under management of close to $9 billion. Okay, so first and foremost, we need to understand who is the issuer as well as what their entity actually is. Okay, next, we can actually look at the track record of the issuer. So the good thing is that now we are looking at Astra 8. Okay, so we have some precedents to actually understand what is the track record of the issuer. So this is part of the Astra series. Okay, if I look at the Astra series, the first two were actually launched in 2006 and 2014, but this were by Temasek. Okay, we saw 𝗲𝘂𝗃𝗀𝗃𝗀𝗃 coming in 2016 with the first listed PE bond on the SGX. Okay, so effectively, that effectively started their issuance of the Astra series. Okay, so we see that there has been one issuance every 1 to 2 years. Okay, so the Astra 3 was in 2016. That was not open to retail investors as yet. Okay, it was listed on the SGX. And then thereafter, we saw the first listed retail PE bond on the SGX in 2018 with Astra 4. Then we have got Astra 5, Astra 6, Astra 7. Astra 7 was the first one with the USD denomination. And that marked the fourth listed retail PE bond on the SGX. And now we are looking at Astra 8. So we have actually the track record of the previous issuances to see whether they have been meeting their bond obligations. Okay, so based on that, we can see what happened to the previous issuances. Okay, so what we see here is that for Astra 3 and Astra 4, they have actually been fully redeemed. And what we see is that in terms of the portfolio cash distributions, they have actually exceeded the initial portfolio net asset value. So that effectively gives us some confidence in terms of the fact that in terms of the previous issuances, they've been able to generate cash from the distributions of the portfolio. Okay. So we do see that Astrea 3 and Astrea 4 have been fully redeemed. For Astrea 5, so the good news that came through for some of the bondholders just a while back is that the Class A bonds have been fully redeemed. And once again, what we see is that in terms of the portfolio cash distributions, they have once again exceeded the initial portfolio net asset value. Okay. What we see is that for Astrea 6 and Astrea 7, because there have been fairly recent issuances, so the core dates have not actually been here as yet. Okay, they'll come down a few years later. So effectively, what we see here is that while they have not been called, we have actually the different issuances having some of the cash already being set aside in the reserve. Okay, so if you are not familiar with this concept of the reserves, that is something that I will share in more detail later. And then we can understand how that actually is something that provides as a safeguard for the bond holders. Okay, so that is the background towards the issuance. Next, we can also try to understand what the credit rating of the different issuances have been. Okay, so if I were to look at the current issuance, earlier I shared that they have an investment grade rating. That is something that is expected based on what Fitch is expected to put out. And if we're to look at what actually would be the ratings and issuance of the previous bonds and how they have effectively evolved over time, that can provide us with some indication around how the different bonds have performed as well. Okay, so once again, we look at the Astrea 3 to Astrea 7 issuances, and what we see here is that they have all started with investment grade ratings. And what we see subsequently is that they have had rating upgrades as the portfolios are able to generate the cash flow to be meeting the obligations. Okay, so that once again would provide us with some indication around the track record of the issuer and what they have been able to do for their previous issuances. Okay, so you might be wondering, okay, so now we understand a bit more about the issuer. How do they actually generate the cash flow to be able to pay the bondholders? And that is something that we then need to understand what the underlying of this portfolio or private equity funds actually entail. Okay, so effectively, when I'm looking at Astrea 8, it is backed by cash flows from a portfolio of 38 private equity funds. Okay, these private equity funds would invest in 1,028 companies, and these are across different industries as well as geographies. Okay, so for those of us who are stock investors, you might not be so familiar with what private equity actually is. Okay, so just as a quick overview of what private equity is, these are effectively companies that are not listed on public stock exchanges. So in other words, they are privately held and the shares are then not available to the general public. Okay, so for those of us who are familiar with investing in Singapore banks, some of the other stocks that are listed on the SGX, private equity would effectively be companies that are then not listed on a public stock exchange like the SGX, and they can only be accessed through some of these private equity funds. Okay, so effectively what we see here and how we can then analyze the performance of the underlying companies would be to look at what are the sectors that they are involved in, when did these funds actually invest into these companies. And what we can see here is that, okay, if I were to start by looking at what industries they actually function in, okay? I mentioned earlier that there are more than 1,000 companies invested by these 38 private equity funds. About 30% of them will be in the IT sector, 18% of them will be in the industrial sector, and 14% will be in the healthcare sector. Okay, when I was looking through the prospectus, one very interesting point that I'd like to highlight is that while there are 1,000 investee companies, there isn't one company that represent more than 1.3% of the entire portfolio net asset value. Okay, so what this may mean is that even if there is going to be one company that is facing financial difficulties, then in terms of the impact to the entire portfolio, if I'm just looking at the largest company, it will be less than 1.3% of the entire portfolio net asset value. Okay. The other thing that we can look at is also when were these private equity funds actually being invested. Okay, so this is what the vintage year actually means. And what we can see here is that 31% of them have a vintage year of 2018. 26% of them have the vintage year as 2019, and 24% of them will have the vintage year in 2017. Okay, so what this means is that on average, what we have for the fund age is about 6.1 years. What we typically see for some of these private equity funds is that for the early years, you probably wouldn't have the cash flow coming through from these funds, okay? Because they actually need to sell some of these investee companies to be able to get back the cash. So what we see is that if it is at a more mature stage, then that is when the private equity funds would then be able to sell their investee companies and actually generate the cash from the portfolio. Okay, so in this case, the weighted average fund age is at 6.1 years. So that would effectively be at the age where they can actually start to generate some cash flow. Okay. The other point to take note of is that if you recall, after 2020, there was actually a surge in valuations for some of these private companies as interest rates were at a very low level. So because the vintage year or some of these funds were slightly earlier, so you might actually see that in terms of the valuation that they might then be investing in some of these investee companies, it might not be at extremely high levels, and that might present the opportunity for them to exit some of these investments and be then able to generate cash from these investments. Okay, the other thing that we can look at is also the geography that this private equity funds actually reside in. So we see that there is actually quite a sizable amount that are in the US, so 63%. Europe will be 20%, and Asia would be 17%. Okay, so this is quite in line with what we see typically for private equity funds, where there is a sizable amount that are actually in the US. Okay. In terms of the strategy of the private equity funds, 36% of them are buyout funds, 24% of them will be growth. And what we see is that the buyout strategy has been something that has been quite performing well historically amongst the different PE strategies. Okay, once again, we can also look at the concentration amongst the different fund managers as well as the individual fund investments. So there isn't any particular fund manager or fund that will represent a very big part of the entire portfolio. Okay. So that is what we mean by diversified, in that it is diversified across geographies, across different fund managers, as well as different sectors. Okay, earlier I mentioned some of the safeguards in place. I think that is something that we need to understand in terms of what this may mean for you as a bondholder as well. Okay, so there are three key things that we need to be aware of here. So the first is the reserves accounts mechanism, in which the cash is actually built up to repay the principal amount of the bonds. We have this requirement for the loan to value ratio to be kept at below 40%. Okay, so the Astra cannot take on too much borrowing, and that is something that they will need to maintain over time. Lastly, there is a credit facility that is in place if there's any cash shortfall that may actually occur. Okay, so I'll go through each of these structural safeguards in a bit more detail, starting with this reserves accounts mechanism. Okay, so how does this reserves account mechanism? Okay, so this is something that we can actually try to understand and then think about how this can potentially affect whether we want to be investing in Class A1 or Class A2 bonds, or whether that will provide sufficient safeguard for us to feel comfortable investing in the Astrea 8 bonds. Okay? So how do we actually look at this? In terms of the waterfall of the payments, okay, there is a certain structure that comes with it, okay? So they have to abide by this payment structure, and that is something that provides a safeguard for bondholders, okay? So first and foremost, in terms of the cash that is generated, that is used to pay the key expenses, okay? So some of these key expenses may relate to expenses that come through from the management of the fund. It may relate to different expenses that may come up, and that is something that will have to be paid first, okay, as the priority of the payment scheme, okay? Next, we have the bondholder interest. Okay, so that is something that we can actually take note of, in that after paying some of these key expenses, they will then have to pay the interest to bondholders. Okay. Okay, what is important to note here is that the Class A1 and Class A2 bonds will rank equally in terms of the payment of the bondholder interest, and there isn't one class of the bonds that actually rank on top of the other. Okay. Okay, next we come to number 3, which is the payment into the reserves accounts. Okay. This is something that I mentioned earlier, and you might be wondering what is actually this reserves account. Okay. So effectively, after the payment has been made towards the bondholder interest, any remaining cash that comes through would have to be reserved, firstly, for the Class A1 bondholders. Okay, so this is what we see here, in that the cash is actually reserved every 6 months to repay the principal of the Class A1 bonds. Okay, so this is something that would then allow the issuer to be able to meet the bond repayment potentially on the scheduled call date, of which the Class A1 bonds would be on the 19th July 2029. Okay, so if you recall at the start of today's presentation, I mentioned a very important feature, which is the call date. And this is where it actually comes in that every 6 months, the cash that comes through from the portfolio of private equity bonds, after repaying the key expenses, after repaying the bondholder interest, it will start to pay into this reserves account. Okay, so it will start accumulating so as to be able to potentially pay back to bondholders on the call date, which is on 19th July 2029 for Class A1 bondholders. Okay. Okay, after it has completed reserving for Class A1 bondholders, that is when it will start to reserve for Class A2 bondholders. Okay, so effectively, there is a certain schedule that comes through with it. and the Class A2 bonds will only begin reserving after Class A1 bonds have been fully reserved or redeemed, whichever is earlier. Okay, so that is something that we can take into consideration when deciding whether we want to apply for the Class A1 bonds or the Class A2 bonds. Okay, so this schedule is important because that effectively allows us to understand our priority of payments amongst different payments that may need to be met by the issuer. Okay, so only after these two are done, then you'll be able to pay some of the other expenses, and more importantly, to pay the equity investors. Okay, so this is where we see that the bondholders have a priority of payment compared to the equity investors. Okay, so this is what we meant by one of the safeguards for bondholders. Okay, next we have this requirement to maintain the loan to value at below 40%. Okay, so earlier I shared the issuance size of the Astrea 8 PE bonds. We have got Class A1 and Class A2, and including the institutional as well as the public offer. We have the total issuance size that is here. And effectively, based on the total net asset value, which is at about 1.47 billion, what we see is that at the point of issuance, the loan to value is at 39.8%. Okay, so what this means is that of the net asset value 1.47 billion, you've got a portion that is made out of equity, representing about 886 million. And then the remaining, which is made out of debt through this offering. Okay, so earlier, if you recall, I mentioned that the LTV needs to be maintained at below 40%. So at issuance, the loan to value will be at 39.8%. And how does that affect us as potential bondholders? Okay, so what we see here is that what this means, and given the priority of payments earlier, the portfolio needs to lose 60.2% of its value before bondholders are impacted. Okay, so because of this loan to value, we see that there is some buffer even if the portfolio value actually comes down, because it will be the equity holders that will be impacted first before the bondholders will be impacted. Okay, and if you're wondering, then who are actually the equity holders of this portfolio? Then that goes back to the sponsor, which is the Auxilia Group, which owns 100% of the equity, and they will take first loss if the portfolio value were to decline. Okay, so in this case, there's an alignment of interest between the sponsor as well as the bond holders. Okay, the last point is really just about this credit facility. So if you're wondering whether there might be times where maybe the cash flow has not been received from the portfolio of private equity funds, so there is a credit facility that is in place, and the issuer may draw on this facility provided to fund certain expenses as well as other amounts that are payable. Okay, so this will actually include any potential unpaid accrued interest on the Class A1 as well as the Class A2 bonds. Okay, but what we need to take note of here is that the credit facility cannot be used to repay any principal amount on the bonds. Okay, so the principal amount still needs to be met by whether or not the portfolio of bonds are able to maintain their value, as well as whether or not there is sufficient cash that is generated from the portfolio for the issuer to be able to redeem the bonds on the call date. Okay, so those are some of the safeguards that are in place. Next, you might be wondering, okay, so we understand the features of the bonds, we understand some of the safeguards that are in place, then what are we looking at in terms of whether the bonds are attractive from a yield perspective? Okay, so I think first and foremost, what we commonly do is just to compare them against the Singapore government bond. Okay, so for those of you who are familiar with the T-bill, this is something that many investors have been looking at over the past 1 to 2 years. There is an equivalent, which is the 5-year Singapore government bond. Okay, so the T-bill would be for 6 months. And then for the 5-year Singapore government bond, as the name suggests, it will be for a longer maturity period of 5 years. Okay, you might be wondering, why do we use 5 years for comparison here? Okay, because if I were to look at, say, the call period, okay, that would be 5 years from the issuance date. Okay, so if we were to think about the issuer being able to redeem the bonds on the call date, so effectively the period in which we might be holding on to the bonds would be 5 years. Okay, so that is why we compare it to a Singapore government bond with a maturity of 5 years. Okay, so if I were to look at the yield of the 5-year Singapore government bond, currently at 3.2%, okay? And if I were to look at the yield of the Class A1 bond, which is at 3.35%, effectively it is at 1.15% over the Singapore government bond, okay? So for us retail investors, we can access the Singapore government bond through the auction or otherwise through the Singapore savings bond. And effectively what we need to then think about is whether we prefer to invest in something that is relatively safer, which is the Singapore government bond. While it is safer, I would still not say that the Singapore government bond is risk-free. Okay, so all investments carry risk. The Astrea 8 PE bonds, I would think, would be slightly higher risk compared to the Singapore government bonds. That is because the underlying is actually in the private equity funds. At the same time, while there are the safeguard mechanisms in place, okay, we need to bear in mind that it is not guaranteed. Okay, so then the question that we need to bear in mind is whether we think that the bond yield of 4.35% offers us sufficient compensation over what we are able to get with a safer asset, which is a Singapore government bond. Okay, so that is the question that I'll be asking myself. Okay, the other comparison that we can do is to compare to existing Astrea issues. Because they are actually listed on the SGX, you can actually buy and sell them through the SGX. So that provides us with a price that we can have a look as to what is the yield being offered by the existing Astrea issues. Okay, quite a number of things that is going on here, but what I will focus on is the yield to call. And the reason that I'm looking at the yield to call is based on what we have done earlier, in that based on the past issuances, we have seen that some of the previous issuances have actually been redeemed at the call date. So to me, I would effectively be looking at what is the yield that I'm able to get between now and when the bond will actually be called. Okay, so what we see is that for Astrea 8 Class A1, the yield is at 4.35%. And if I were to look at some of the other Singapore dollar denominated previous Astrea issuances, based on the price that they are trading on the SGX, the yield to call would be at between 3.43% to 3.57%. Okay, so what we see for the Astrea 8 yield at 4.35% is actually above this range. Okay, you can compare to some of the other bond issuances as well. So we see here Temasek bond, there's one that's maturing in November 2026. The yield to maturity is 3.82%. We have some of the corporate issuances such as Thomson Medical, IFAS. These bonds are not rated. And in terms of the yield to maturity, they'll be between 4.27% and 5.56%. Okay. Okay, so if I'm looking at the Class A2 bond, 6.35%, once again, we can compare them to existing issuances that are trading on the SGX. And based on the prices that we see, the yield to call for some of these existing issuances would be in the range of 4.62% to 6.61%. Okay, so you can do this similar comparison, and from there you can actually do a comparison whether it might be more worthwhile to apply for this issuance, or actually there might be other opportunities that are out there based on what we see on the prices of existing issuances. Okay, so far I've shared some of the features of the Astrea bonds. I've looked at how the yield is compared to the Singapore government bond, as well as other issuances. As I've been sharing over the webinar, all investments come with risk. So I would also want to highlight some of the risks relating to the Astrea 8 offering. Okay, so I think first and foremost, investment risk. So if I were to look at the underlying asset and where the cash flows are actually generated from, we spend quite a bit of time going through what are the underlying assets, what is the portfolio of private equity funds held by Astrea 8. So once again, what we need to be aware of is that the cash flows are actually dependent on these private equity funds, and the risk is always that the amount and timing of such distributions can be uncertain. Okay, so that's something that we need to be aware of. The next relate to market risk, because we see that the macroeconomic conditions can actually fluctuate. This can be because of inflation, this can be because of global trade tensions, or even a global pandemic like what we saw over 2020 to 2022. So if there were to be any adverse macro development, that can impact the valuation of this private equity asset. It can also impact how some of these private equity funds are then able to exit some of these investee companies, and thereafter affect the cash flow that is coming through from the private equity funds. Okay, so that's the second point on market risk. The third point is really on leverage risk. So private equity funds actually make use of leverage to increase the exposure of the investee companies. Okay, so leverage is a feature of private equity funds, and because of that, if there is going to be a sharp increase in interest rates, as we can see, given the use of debt, that can potentially impact these private equity funds. Okay. The fourth point is really relating to liquidity risk. Okay. So while the bonds are going to be listed on the Singapore Exchange, something that we need to be aware of is that the trading market for the bonds may be limited. And because of that, you may not be able to exit if you were to want to exit at any point in time. Okay. The other point is that while there is a call date that may be 5 years from the issuance date for the Class A1 bonds and 6 years for the Class A2 bonds, okay, there's no guarantee that they will be redeemed during these call dates. Okay, so effectively, if I were to be investing in these bonds, I need to be comfortable having my money in these bonds, because there is no guarantee that there is liquidity for me to be able to sell these bonds. Okay, one thing that I would like to highlight is relating to Class A2 bonds, okay? And this really foreign currency risk, okay? Because the Class A2 bonds are US dollar denominated, so if your investment currency is not in US dollars, what this means is that you will be subject to exchange rate fluctuations, okay? So while the yield is higher for the Class A2 bond, we need to be aware of this additional foreign currency risk. If your investment portfolio is in Singapore dollars, if you are actually planning your retirement based on your Sing dollar savings, then what you need to bear in mind is that while the A2 bonds actually offer a higher yield, if there's going to be a sharp depreciation of the USD relative to the Sing dollar that can potentially eventually impact your total returns from a Sing dollar perspective. Okay, so something to bear in mind if you are considering the Class A2 bonds. Okay, so having shared the features of the Astrea bonds, how I would think about the yield compared to other issuances, the question that you might have would be then how do we apply for the Astrea PE bonds? Okay, so effectively, you have to do it through DBS, OCBC, or UOB, and this can be done through the ATM, mobile banking, or internet banking websites. Okay, for Class A1, the minimum application size is 2,000 Sing dollars, and you need to apply in multiples of 1,000 Sing dollars. Okay, for Class A2 bonds, the minimum is in US 2,000, and you apply in multiples of 1,000 US dollars. Okay. Some of the key dates to be aware of, we see that the application has actually opened this morning on the 11th of July at 9 a.m. The other key dates to keep a lookout for is that the closing date for the application would be on 17th July at 12 noon. And then if the listing is successful, the trading will start at 9 a.m. on 22nd July 2024. Okay, so these are some of the key dates that we need to be aware of. The closing date is on 17th July, which is next Wednesday, and that would leave us more time to do our research, understand more about the issuance. In fact, attend the webinar being organized by the company and understand more about what is the issuance about and whether it fits our investment objectives as well as risk appetite. Okay, I've also observed some of the questions that have been asked in the Beansprout community. So I thought I'll just address some of this upfront. Okay, so one of the commonly asked questions is how much allotment will I be able to get? Okay, so there is no clear answer to this at this point in time because it depends on how much applications actually come through for the Astrea 8 bonds. But what I've done is to look at the allotment result for Astrea 7, which can potentially provide us with some indication. Okay, so what we see here is the allotment result for Astrea 7. Okay, and what we see here is that for those who applied 9,000 Sing dollars and below, they were allotted as per applied. Okay, so what this means is that for those who applied for $5,000 worth of Class A1 of Astrea 7 bonds, they would receive an allotment of 5,000. Okay, but if I were to look at those who then applied between 10,000 to 24,000, okay, then effectively what they would get would be $10,000 worth of the Class A1 Astrea 7 bonds. Okay, so that is something that we can use as an indication. Okay, the other point to keep a lookout for is this thing called the balloting ratio. Okay, and this is a question that I've seen being asked as well. So what we see here is that for those who applied for more than 50,000 Sing dollars of the Astrea 7 Class A1 bond, okay, the amount that was allotted per successful applicant is actually 22,000 Sing dollars. Okay, but what we need to keep a lookout here for is that the balloting ratio is 1:2, which means that not all who actually applied for the Astrea 7 Class A1 bonds with an amount of above 50,000 were actually successful in their application. Okay, so that is something that we can consider when we are thinking about what amount of Astrea 8 bonds we want to be applying for. Okay, So we can do a similar exercise for the US dollar denominated class of the Astra 7 bonds. And what we see here is that for those who applied for 25,000 and below, they were able to get the amount that they applied for. And then those who actually applied for more, if you were one of the applicants for the Astra 7 Class B bonds, and you applied for 26,000 to 29,000, then you would have been allotted 25,000 of the Class B bonds. Okay. The balloting ratio for the US dollar bonds, what we see here is that those who applied were able to get the Class B bonds of the Astra 7 issue. Okay, so that is a recap of the Astrea 7 issuance. At the end of the day, for the Astrea 8 issuance, it will still be dependent on the applications that come through, but hopefully by looking at this, we'll be able to get some indication. Okay, so this is something that I picked up from the prospectus. Okay, you will have a higher chance of getting an allocation if you apply for less than 50,000 of the Class A1 bonds and US dollar 50,000 of the Class A2 bonds. Okay, so this because the issuer actually wants to be able to look at what some of these smaller applications are able to get. So effectively, based on what we see in terms of the Astrea 7 allotment is, you have a higher chance of getting an allocation if you apply for less than 50,000 of the Class A1 bonds and US 50,000 of the Class A2 bonds. Okay, so in summary, based on what I've shared, we believe the Astrea 8P bonds may be attractive for investors who are seeking regular income, particularly over a longer duration compared to, say, a 6-month treasury bill. And I think based on what we have shared, what we see is that Astra has got a track record in terms of meeting their obligations. And what we also like would be the various safeguards in place. Okay, but while we have shared what are some of the track record around Astra series as well as the safeguards in place, we still need to be mindful of the risk relating to the Astra bonds, which is something that I shared during today's webinar as well. Okay. Between the Class A1 bonds and the Class A2 bonds, given the premium that we are able to get versus the existing Astra issues, my preference would be for the Class A1 bonds over the Class A2 bonds. And what is important to bear in mind for the Class A2 bonds is that if your underlying investment currency is not US dollar, then you would have the additional currency risk relating to any volatility between the US dollar versus the Sing dollar. Okay, so that is my presentation on the Astra 8 bonds. So with that, I'll end tonight's session. Thanks so much for joining us today. I hope that I've been able to share some of what I know about the Astra 8 bond issuance with you, and do have a nice evening ahead. Okay, thank you everyone for joining us tonight.